Hello and welcome. In our episode today, we bring you each and everything you want to know about index funds. So let's get started. When you start investing in the stock market for the first time, the thought of having to choose your own investments can be enough to discourage anyone from getting started. But what if you could invest in the entire stock market? That's where index funds come in. Index funds are a type of investment vehicle that have become increasingly popular in recent years. You may have heard of the S&P 500 and the Dow Jones Industrial Average, as those are two of the most popular indexes. The S&P 500 is a market index made up of 500 of the largest companies in the stock market. The Dow Jones Industrial Average is an index that tracks 30 of the largest and most traded blue-chip companies in the market. So what exactly are index funds and how can you get started investing? Index funds give you broad exposure to large segments of the entire stock market with a single fund. They tend to be low cost and help you diversify your investment across multiple assets within your portfolio. That means your money isn't tied to one single stock, which helps protect you from any downturn in the market. Index funds track a specific index, and there are many different types of index funds. Depending on the index fund, your investments can be automatically organized across different types of stocks, bonds, or other asset classes. How do index funds work and how to get started? The goal of an index fund is to match the market, not beat it. In the case of an S&P 500 index fund, the goal is to achieve returns identical to that of the S&P 500. When an individual invests in an index fund, they essentially invest in every security that makes up the underlying index. Investing in index funds rather than individual stocks allows you to diversify your portfolio and reduce your risk of loss if one company performs poorly. You can create a complete, well-diversified portfolio with just a few index funds. You can get started in investing in index funds pretty quickly. Keep in mind, though, that the name of this game is long-term, so it's best if you get started early and plan to keep your investments for a long time. First, pick an index. If you're starting out, a broad-based index fund like the S&P 500 or a total market fund is a good place to start. Look for index funds that have the lowest fees, also known as expense ratios. For example, Fidelity has a 500 index fund with a 0.02% expense ratio. Then you need to buy shares. Every type of investment, including index funds, carries some level of risk. As a result, it's possible to lose money. But index funds are a long-term investment strategy, and the market has historically trended upward. As a result, with a buy and hold strategy, you are unlikely to lose money. You can invest in index funds through taxable brokerage accounts like Fidelity or Vanguard, or you can invest through your retirement accounts like a 401k or a traditional or Roth IRA. Once you buy shares, be sure to continue to invest every month. Even though index funds are great to set and forget, continuing to invest in them is key. Be sure to figure out your investment goal and continue to invest that much every month. A compound interest calculator can help you project earnings over time. You can use this calculator to figure out how much you need to deposit over a specific period of time to meet your goal. For example, if you deposited $10,000 into an investment account and that investment grew an average of 7% for the year, you will have made $700. After 30 years and a 7% return, you will have made $76,000. Compound interest and time is the secret sauce in investing. Index funds have been around for more than 45 years, and many of the indexes they track have been around far longer. As a result, there's plenty of historical performance to look at to see how they perform. Index funds often have lower fees or expense ratios than other funds on the market. These low fees allow investors to keep more of their earnings. Index funds are tax efficient because there is less turnover ratio. That's a number percentage calculated depending on how many companies are replaced in a fund. Funds with high turnover rates have higher taxes. Index funds are passively managed, which means the fund manager isn't actively buying and selling securities to try and outperform the market. Many mutual funds are actively managed. Well, that's all for today's video. Stay tuned with us. Make sure to like and comment to the video. Subscribe to the channel so you can keep getting updates about all our new uploads. Have a great investing!